What's up everybody, welcome to the channel. Soil here, and today I want to talk about Bollinger Bands. It's a very popular indicator and it's widely used by traders in Forex for stocks, futures, cryptocurrency or any other financial markets. It was developed by the famous technical analyst and trader John Bollinger in 1980s. It gives us a unique insight into volatility change in conjunction with the price movement. If you're interested to learn this amazing technical indicator and use it in your trading system, stay tuned and let's get started. Alright, let's see what Bollinger Bands are. Bollinger Band indicator has a middle band which is a simple moving average, usually with length of 20, and we have two outer bands, and they are standard deviation, which are located with a fixed multiplier above and below the middle band. The multiplier is usually set 2, which means that the upper band and lower band are two standard deviation from the middle band. So the upper band equals to moving average plus 2 standard deviation, and the lower band is equal to moving average minus 2 standard deviation. The reason we use simple moving average for the middle band and not exponential moving average is that standard deviation is calculated based on simple moving average. Based on your trading style and system and the market you're trading, you can adjust the setting. Just pay attention that when, for example, you increase the length of moving average, the number of periods used in the calculation of a standard deviation is also increases, so you need very small changes in multiplier. Bollinger has a guideline for this, with standard setting, which is simple moving average with length of 20 and the multiplier set 2. He recommends that for simple moving average with length of 50, 2.1 would be adequate for the multiplier, and for the moving average with length of 10, 1.9 is suggested. Just pay attention, the settings that he suggests may suit to a particular market or to the time he was researching on this indicator. Some securities have higher volatility and some have lower volatility. Sometimes the market as a whole is more volatile and sometimes is less volatile. So you must carefully test with different settings and see what setting suits your trading style and the market you're trading. As I said, the distance of the upper and lower band from the middle band is based on standard deviation. Standard deviation shows volatility, so they show the volatility of the price, and when the market becomes less volatile, the outer bands contract or become tighter, and this squeeze gives the possibility that we may have a sharp move in either direction, ideally on high volume. So when there is a squeeze, it shows that we have very low volatility, and it's a sign that we're going to have increased volatility, and it can be the starting point of a new trend. As you can see on this chart, following a trading range, we have a squeeze here, the bands contracting so tightly as you see, and it shows we have very low volatility here at this point. That gives the possibility that volatility may increase and a sharp move may start either up or down, and as you can see, after that, the price moved upward and a strong uptrend formed on the chart. And here, following a downtrend, as you can see, we have a squeeze. And after that, we have reversal and the direction of the downtrend changed to an uptrend. Also, take a look at the volume and see how it's increasing when the price is breaking out of the squeeze. Pay attention that the squeeze doesn't give you a trading signal, and it doesn't tell you when the move is gonna start or on which direction the price may go. All that the squeeze tells us is the possibility of increasing in the volatility and a sharp move or starting a new trend in either direction, so you shouldn't see it as a standalone buying or selling signal. When the market becomes more volatile, the outer bands expand or become wider, so if you see the bands are widening relatively in large amount, it shows that we have high degree of volatility and there is a potential in decreasing of the volatility, or in other words, the existing trend is weakening and there is a possibility for reversal. As you can see here on this chart, the bands are widening, which shows that we have too much volatility and there is a possibility that we're going to have decreased volatility, which means that the current trend is weakening. And as you can see, after that the price went to a trading range. Just pay attention that before the widening of the bands, we have a squeeze. Following a downtrend, as you see, we have a squeeze. and after that a sharp move in the direction of the downtrend, which created this widening of the bands. And here also, as you can see, the bands are widening, which gives us the possibility that the existing uptrend is weakening and there is a potential for changing in the direction of the price. And as you see, after that we have a reversal and the price turned down and a downtrend started. Again, I repeat, just pay attention that here these widening bands just give us possibility and they are not a standalone buying or selling signal. Based on statistical principles, approximately 90% of the price action happens between the upper band and lower band. So when the price touches the lower bands or breaks it and go below the lower band, it shows that the price has decreased too much and there is a possibility that the price is going to bounce. And when the price touches the upper band or breaks it and go above the upper band, it shows that the price advanced too much and there is a possibility that the price is going to fall. Pay attention that the bands are two standard deviation from the mean. So the overbought and oversold that we identify by the help of Bollinger bands show that the price has deviated from the mean or average, the moving average line that we have here. As you can see on this chart, every time that the price touches or exceeds the bands, it changes direction and goes the other way. Also pay attention how the bands are widening and contracting, widening on the sharp moves in the direction of the downtrend and contracting in the corrections, which again gives the possibility of a sharp move in the direction of the downtrend. And here at the end of this downtrend, as you can see, widening bands, a squeeze, and after that a reversal and the price went to an uptrend, which shows that here the price decreased too much and there was no more sellers at that price and buyers stepped in, taking the control of the price, pushing the price up, and as you see, changing in the direction of the market. And here in this case, as you can see, following an uptrend, we have a trading range, and every time that the price touches or exceeds the bands, it changes direction and moves to the other band. In trading ranges, when the market is moving sideways, the price has more tendency to bounce between the bands, touching one band and then moving to the other band. In other words, these overbought and oversold that are identified based on mean reversion principle can work better in ranges in compared to a situation when the market is in a trend. In strong trends, the price may stay overbought or oversold. You must understand this, that the bands are two standard deviation from the moving average line, and as I said, statistically approximately 90% of the price action is between the bands. So when the price reaches the bands, it shows that the move was strong, that the price is touching the bands. So for the price to touches the bands, or in other words to go to overbought and oversold levels, the movement must be strong. In strong uptrend, overbought, and in strong downtrends, oversold can extend and continue, which it's said that the price can walk the band with many touches before any change in the direction, whether it's a correction or reversal. Even in ranges, we can have this condition and the price may stay overbought or oversold, especially when the price is going to break the range and to start a new trend. So how can we prepare ourselves to deal with the condition that I just explained? One way to lower the risk of going to these wrong trades is to open a position in the direction of the trend. You must see what the overall trend is and only take positions that are in the direction of the trend. For example, here we are in an uptrend, as you can see, and we only go long when the lower band is tagged, and the upper band can be your profit target if it's desired. And we should not go short because it's against the existing trend. And in the situations like here, when the price is walking the band, it can be a losing position. And here in this chart, as you can see, we are in a downtrend and we only go short when the upper band is tagged. And we don't open a long position because it's against the existing trend, and it can be a losing position when the price walks the bands. In strong trends, the price may never touch the lower band in uptrends or the upper band in downtrends. In these situations, sometimes the moving average line may act as support level in uptrends or resistance level in downtrends and can provide buying or selling opportunities. As you can see here on this chart, we have a strong downtrend and the price couldn't touch the upper band, and the middle band, which is a simple moving average with length of 20, is acting as a resistance level, and when the price touches it, it turns down and go lower, which provides selling opportunities. And here we are in a strong uptrend, and the price couldn't touch the lower band, as you can see, and the middle band is acting as a support level, which brings opportunity to buy at these points. Just pay attention that these touches of the bands or exceeding the bands are not trading signals, and Bollinger describes them as tags, and you shouldn't use them as a standalone trading signals. And all that these tags say is possibilities. So you must have other tools in your trading system that confirm the trading decisions that you want to make. Many professional traders use Bollinger Bands because it offers a unique insight into the market based on volatility. However, it shouldn't be considered as a standalone trading system because it only takes price and volatility into account, and it doesn't consider other information that are needed for trading. John Bollinger recommends that we must use Bollinger Bands with a few other indicators that are based on different kinds of data, so that the buying or selling signals that we want to trade will have higher degree of accuracy. He suggested some of his favorite indicators that are suitable to use them with Bollinger Bands, which are MACD, unbalanced volume, and RSI. In this video, I explained MACD. It's a complete guide on MACD and how it's used for trading. I recommend you watch the video later because MACD is one of the most effective indicators that can be very helpful in your trading. In next videos, I'll explain unbalanced volume and RSI, which are also very popular and powerful in trading, and you must learn how to effectively use them in your trading system. Alright, that's it for now. I want to thank you for watching, and I hope this video has been helpful for you. If you have any question, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. Please subscribe to my channel. Don't forget to hit the bell and make sure you watch my next videos. Step by step, I'll take you through it. Let's beat the market.